AI versus interest rates. Which force wins? Tonight, Micron Technology answered that question, and the answer is a blowout. Q2 fiscal 2026 revenue, $23.9 billion. That is 196% higher than the same quarter last year. Operating margins, 69%. Earnings per share, 12.07 on a GAAP basis, 12.20 non-GAAP. Operating cash flow, 11.9 billion. These are not normal semiconductor numbers. Memory chips are cyclical. They boom. They bust. That cycle has defined this industry for 40 years. But something broke the pattern. AI capital expenditure from hyperscalers like NVIDIA, Microsoft, and Google created a demand shock so large it overwhelmed the gravitational pull of 3.5% Federal Reserve interest rates. Tonight's earnings are the scorecard. Two macro forces collided inside one company. AI spending pushed demand to record levels. High rates compressed inventory cycles and raised customer financing costs. One force won. The numbers make the winner obvious. Start with the top line. Micron posted $23.86 billion in Q2 fiscal 2026 revenue. The prior quarter delivered $13.64 billion. That is a 75% sequential jump. One quarter, 75%. For context, Q2 fiscal 2025 revenue was $8.05 billion with 36.8% gross margins and 1.56 in non-GAAP earnings per share. 12 months later, EPS hit 12.20. That is an 8x increase in earnings per share in a single year. GAAP net income reached $13.79 billion. Adjusted free cash flow, $6.9 billion after $5 billion in net capital expenditures. CEO Sanjay Mehrotra announced a 30% increase in the quarterly dividend on March 18, 2026. Companies do not raise dividends 30% when they see softness ahead. They raise dividends when the forward pipeline is oversubscribed. The board's signal is unambiguous. This demand cycle has duration. The data center business unit tells the real story. CDBU gross margins hit 74% in Q2. That is 23 percentage points higher than Q1. Data center NAND revenues more than doubled quarter over quarter, doubled in 90 days. High bandwidth memory is the product driving this. Every AI training cluster and inference farm needs HBM. NVIDIA's H100 and B200 GPUs consume massive quantities. Micron supplies it, and supply is tight. Mehrotra said on the March 18th earnings call at 2:30 p.m. Mountain Time, "In the AI era, memory has become a strategic asset." That phrase matters. Strategic assets attract long-term contracts. Long-term contracts insulate suppliers from rate-driven inventory destocking. When your customer is Microsoft or Google building AI infrastructure on 5-year capital plans, the federal funds rate becomes secondary to securing supply. Now the opposing force. The Federal Reserve held rates at 3.5% through early 2026. For semiconductor companies, high rates do three things. They raise the cost of customer financing for large hardware purchases. They compress inventory cycles as distributors hold less stock. They reduce speculative capital expenditure from smaller buyers. In 23 and 24, this mechanism crushed the memory market. An inventory glut formed. Prices collapsed. Micron's margins contracted below 37%. The traditional semiconductor cycle played out exactly as monetary policy textbooks predict. But 25 changed the equation. AI demand from hyperscalers operates on different logic. These buyers carry balance sheets measured in hundreds of billions. Their cost of capital matters less than their cost of falling behind in the AI race. Rate sensitivity drops to near zero when the strategic imperative is existential. The margin structure proves which force dominated. Q2 fiscal 2026 consolidated gross margins, 69%. Q3 guidance, approximately 81%. For a memory company, 81% gross margins are extraordinary. DRAM and NAND have historically been commodity products with margins oscillating between 20% and 50%. 81% belongs in a software company's earnings report, not a chip maker's. This expansion happened while rates sat at 3.5%. The mechanism is pricing power. When AI demand absorbs all available HBM supply, Micron sets the price. Customers accept it because the alternative is delayed AI deployment. Every month of delay costs hyperscalers billions in unrealized revenue. Capital expenditure confirms the conviction. Micron spent $5 billion net in Q2. Mehrotra emphasized investing in the global manufacturing footprint for hyperscaler customers. Building fabs while rates are elevated only makes financial sense if demand visibility extends years, not quarters. AI's pull extends well beyond the data center. Micron's mobile and client business unit posted record revenue of $7.7 billion, representing 32% of total sales. Sequential growth, 81%. Gross margins expanded from 36% to 54% in a single quarter. On-device AI is driving memory content per smartphone and laptop structurally higher. Apple Intelligence features, Samsung Galaxy AI, and Microsoft Copilot PCs all require more DRAM and NAND per unit. This is a platform shift, not a seasonal uptick. The automotive and embedded business unit hit a record $2.7 billion, 11% of total revenue. Sequential growth, 57%. Gross margins, 68%, up 23 percentage points quarter over quarter. AI-powered advanced driver assistance systems demand memory densities that did not exist 3 years ago. Every end market moved in the same direction. AI is not a single customer segment. It is a demand multiplier across the entire semiconductor stack. Q3 fiscal 2026 guidance removes remaining doubt. Revenue target, $33.5 billion, plus or minus $750 million. That is a 40% sequential increase from Q2. Gross margin guidance, approximately 81%. Non-GAAP EPS, 19.15, plus or minus 40 cents. Wall Street consensus before tonight set at 1077 EPS. Micron guided to nearly double that figure. The magnitude of the beat is not a rounding error. It represents a fundamental underestimation of AI demand velocity by the sell side. Compare this trajectory to the rate environment. The Fed has not cut. Rates remain at 3.5%, and Micron just guided to 81% gross margins with 40% sequential revenue growth. Two macro forces collided. AI capital expenditure won decisively. For investors tracking semiconductor cycles, this quarter becomes a reference point. Memory cyclicality will reassert itself eventually. But as of March 18, 2026, AI demand has broken the pattern. The scorecard is final. Subscribe to the Ledger for data-driven breakdowns of the macro forces moving markets. New deep dives weekly.